Hey guys, Dave Keller here with Market Misbehavior. I love to ask interviewees what their one chart would be. And that is, if you had one chart, just one chart, besides a regular chart of the S&P 500, what would it be and why? Our chart today is gold, in particular the gold ETF, ticker GLD, and why Fibonacci retracements can be a really valuable way to identify potential turning points. So gold has been in an established downtrend for about 6 months now. The GLD, the gold ETF, peaked out in August, and from there has been sort of in an extended downtrend. What's happened though is it's hit a key Fibonacci retracement level in the last couple days, and on Tuesday of this week bounced really nicely right about where it should have as it became oversold. I think it's a really interesting illustration of the potential to combine Fibonacci retracements with other forms of analysis. Before we get to that, please hit subscribe if you're interested in this sort of analysis, thinking about investor behavior, decision-making routines, and focusing on the message of the markets through the charts. Hit a like if you find this video interesting, and leave me a comment below. Tell me if you think gold is positioned to go higher or lower. What's the next 10% move in gold, in your opinion? Let's get to the chart. All right, so here is the daily chart of gold going back for the last 2 years. And basically doing a daily bar chart, open, high, low, close. There are a lot of lines on here, so apologies for that. And in general, I tend to advocate simplifying. So I'm a little disappointed in myself that I have this many lines on the chart. But what's funny is the sort of cluster of prices and lines and moving averages here really shows you what a congestion pattern we had there at the beginning of 2021. So I think it actually reflects the indecision in the market at that point. So I'm going to leave it as it is. But basically, we're looking at price over the last 2 years. The next panel down is the RSI, a measure of momentum. So green above 70 means it's overbought. It's gone too high too quickly. Below 30, it's oversold. It's gone too low too quickly and expect it to bounce higher. The bottom is just showing you the relative performance of gold versus the S&P 500. Let's actually start there. And if you look, starting the clock at the market low, the equity market low in March of 2020, you can see that since then, with a little bit of a mean reversion there in June and July of 2020, besides that, it's been in a pretty consistent downtrend the whole time. Basically meaning gold has been underperforming stocks consistently. Again, after the June market peak, gold rallied pretty good and stocks did not. That's why we saw some outperformance there. But overall, it's been sort of a consistent downtrend. So what's happened on a price basis? Well, gold rallied out of a mid-March low and basically accelerated up to hit a peak in early August. From then, that's been the high in gold for 2020 and for 2021. Since then, it's been a pretty consistent stepwise motion lower and lower. What was interesting about the chart of gold, if you look at the GLD, is this rally here in December was very tempting. And I know for me, as I was reviewing this, as I was talking to clients, I focused in on the resistance level from November. And I remember thinking and saying, if we break above that high, you have to acknowledge that we've reversed from a downtrend to an uptrend. That would mean we've broken up through this trend line using the previous highs. That would mean we've broken to a new swing high, meaning we're now making higher highs, potentially higher lows. That would be a much more constructive pattern. If you look, we failed right at that resistance level and then rolled over. So when I talk about support and resistance levels often in my work, it's because markets have a memory. They tend to key in on key turning points, key price levels that have meaning for investors, have meaning for traders. So it's important to always start where we're at, look to the left on the chart and find the key turning points. That often can be a really good place to start if you're looking at a chart for the first time. Now, just to orient ourselves a little bit further, going back here in 2019, you had this consistent sort of pattern where gold would rally, then consolidate a little bit, pull back a bit, usually about 38.2% of the way, and then rotate higher and go to new highs. That happened a couple times over the last couple years, 2018, 2019. 2020 sort of changed things with gold really rallying to the upside before topping out in summer of last year. If you look, though, the pullback that we saw in March, so from February to the early March period, gold actually continued higher while stocks were rupturing and going down. From there, gold really came off pretty good and bottomed out in the middle of the month. But if you look at the GLD, pulled right back to the lows from November of 2019. So that level is really, really important. It's around 136 on the GLD. So if we start the clock there at the March low, We then take the high in August. The Fibonacci retracements basically retrace or measure between those two extremes, 38.2% of the way down, 50% of the way down, and 61.8%. And those two, 38.2% and 61.8%, are the key levels to pay attention to. What I'm always interested in is when we have what's called a confluence of support or a confluence of resistance. This is when something like Fibonacci retracements lines up really well with a pre-existing support level. So from this low in March to the high in August, when we came back down, you can see that the 61.8% retracement level lines up really well with the February and March peaks of 2020. Also the lows in April, May, and June. So you had a number of times where you tested that level around 157, 158 or so. So that has become a really important sort of magnet price for the GLD. So as things rallied, as things came down, that became a very clear downside objective, in my opinion, for gold. So what happened is it traded down, chopped around for quite a bit. It really settled in and spent a ton of time around this 38.2% retracement level. That was this sort of jumble of prices and moving averages and lines and stuff around January of this year. From there, it broke down, made lower highs, lower lows, finally broke below the November price low, which was pretty important, and now has come right back down to that same level around 157, which is, again, the Fibonacci support level, but also lines up with these highs from early in 2020 and the lows from the middle of 2020. So that is a really important support level. We reached it early this week and then bounced up, and this is Tuesday's sort of gap higher on the GLD, closing up around 2% overall to close just above 160. So what this tells you, and one other thing to note, by the way, is that the GLD became oversold right as it reached that Fibonacci level. So when I think about, the technical toolkit, anytime you have multiple disciplines, different calculations, different styles of indicator that all sort of confirm a specific thesis, that's sort of a powerful signal, right? I think the repetition, that the fact that this signal is mirrored in different patterns by different techniques is very important. So the fact that we were oversold right at a pre-existing support level, which was also a 61.8% retracement of this key move from 2020, all lined up to suggest we're at a really good time for a bounce here. That's what we've begun to see. And the question is, do you see further upside in gold? Do we see a further bounce from here? Overall, my toolkit would suggest yes. After a big run like this, the long-term uptrend that we've had in gold, a pullback of around 61.8% is a pretty common occurrence within the context of a longer-term uptrend, right? The trend could revert higher and be in a long-term uptrend, and this would make a ton of sense from a technical perspective. If you would break 157, 150, about 157 or so, break below this final support level, there's really nothing left on the chart down all the way to 136. And that would be the ultimate low that I would expect if we do break 157. So at this point, we're oversold. We've reached this key support level. What happens next? So, step one, or option one, we break higher. Gold is usually thought of as an inflation hedge. And a lot of people have wondered why we're not seeing gold move higher. Walter Deemer, who's one of my mentors, ran the technical research team at Putnam in the 1970s, worked at a number of other shops as well. He basically had pointed out earlier this week, why are we not seeing gold rally if people are really worried about inflation? And again, it's all about inflation expectations and what's being priced in the market. The fact that gold is still going down tells you it's really not much of a concern yet overall for investors. A bounce in gold would suggest increased fears of inflation, which has a lot of ripple effects for other asset classes as well. So what would that potentially look like? Well, the last time that the GLD was oversold was back here at the end of November. From there, we had about a 10% bounce. I'm going to bring up this other chart, which zooms into that period a little bit. So now we're looking at just the last 1 year. You can see from the November low to the subsequent peak, we gained about 10.3%, which put us right about at that November swing high. That was basically the point I talked about earlier in the video when I mentioned we were right at that level. If we broke above it, that seemed very bullish. We did not. We failed there, which suggests there wasn't enough upside momentum for gold. A 10.3% move from the current close, or from Monday's close of this week, would put us around 173 or so, 173.50, which interestingly enough puts us back at the 38.2% retracement level, which is right at this jumble of stuff, this jumble of prices and moving averages, this confluence of resistance. So from a technical perspective, that makes a ton of sense that you would find resistance back where we've found resistance before. This is also where the 200-day moving average is. It's right above that level currently, around 174. It's going to start to decline here if prices remain in this area, or it certainly will flatten out. So you sort of have this confluence of resistance around 10% higher from where we closed on Monday. So that's a reasonable upside objective that would still make a lot of technical sense. And then you sort of have to recalibrate and figure out what's going on. What would that mean potentially for stocks? Well, a lot of people think of gold as a safe haven. And if they would see gold rally 10%, they think, well, that means stocks and other risk-on assets are probably coming down. I'd be careful with that sort of thinking, because as much as people talk about gold as a safe haven, with the idea being if stocks go down, gold will probably go up. Because people are flocking to a safe asset, hasn't really been the case consistently. There are times when stocks and gold diverge and they go opposite ways, but there are plenty of times when they actually move together. Today, for example, gold and stocks both bounced on the same day, both moved higher. So it's not necessarily a safe assumption to think that there is a particular movement you could expect from stocks just based on gold rallying to a certain level. I tend to suggest that people look at the charts independently, focus less on intermarket analysis, intermarket conclusions, and drawing cause and effect conclusions that may not be backed up by the data. I would focus on the charts themselves, lean into what's working, lean away from what's not working. What would suggest to me that this sort of thesis is wrong? Very simply, we break below 157 and we stay there. A confirmed close, a valid move below that level would suggest to me that the GLD goes down to around 136. That would be the lows from back here from early 2020 and late 2019. So that is the take on gold using price analysis, support and resistance, Fibonacci retracements, moving averages, RSI, a little of everything. So that is your one chart for today, focusing on gold and the importance of Fibonacci retracements to identify potential support and resistance levels. As a reminder, if you like this sort of thinking, focusing on the charts, the message of the markets, investor behavior, decision-making, hit subscribe. I'd love to have you as a subscriber to the channel. Hit like and put a comment below the video. Let me know what you think is next for gold. 10% move coming next is higher or lower. From everyone here at Market Misbehavior, I'm Dave Keller. Be safe. Talk to you again soon.